If you own or have contemplated owning life insurance inside a corporation, there's something that you really need to keep your eyes out for and be careful of. Most advisors will tell you that corporate life insurance is tax efficient, and that is very true. But what many advisors forget to mention is that owning a life insurance policy in the wrong corporation could really jeopardize your financial situation. Specifically, life insurance is a passive asset, and even though it's not taxed as one on your regular accumulation on an annual basis, it is considered passive asset for the Lifetime Capital Gains Exemption qualification under the rules for the qualified small business corporation. The culprit is accumulated cash value. So in a very quick video, let's break this down. So corporate life insurance is very popular for a number of reasons. First, the policy cash value grows on a tax-exempt basis. And this is unlike any other asset class in Canada inside a corporation. Unlike investments in a corporation, which are taxed very punitively on their accumulating annual returns or realized capital gains, policy cash value is generally tax exempt. Secondly, if the insured party passes away, the corporation receives the death benefit and the growing death benefit on a tax-free basis. And the majority of that death benefit can be used as a credit to the capital dividend account. Now, this electively can be paid out as a tax-free or capital dividend by triggering the right election. Any positive balance in that CDA will allow for the election of a tax-free or capital dividend. If you have a negative balance in your CDA, you do not have the room to pay out a tax-free or capital dividend. On the surface, all this seems pretty straightforward, but here's where it gets tricky. From a tax perspective, life insurance acts in two different ways depending on how you're measuring it. When we're talking about annual income attribution, the policy gains are not attributable, they are exempt. This means that it doesn't contribute to the passive income rules and the clawbacks to the small business deduction. By losing the small business deduction, business owners can pay up to $75,000 in additional taxes. So far, so good. But when we switch to measuring assets, now the story tells something different. The cash surrender value on a policy is considered a passive asset on the corporation's balance sheet. And that matters tremendously when you're considering selling your company. Now, to claim the Lifetime Capital Gains Exemption, your corporation has to qualify as a QSBC, a Qualified Small Business Corporation. One of the key assets to determine whether your corporation qualifies as a QSBC is the asset test rules, which is upon immediate sale and a look back onto the 2 years prior to sale. In simple terms, 90% of the assets used in the corporation must be used towards the creation of active income at the time of sale. The look back is a 50% number 2 years prior to sale. Now imagine this scenario. Your company has assets of $5 million and $4.4 million of those assets are used towards the creation of active business income. However, you also have an insurance policy with about $600,000 of cash value owned by the same corporation. Now, the 90% rule in this case is tainted and your company will not qualify for the Lifetime Capital Gains Exemption. Now, why is this important? Well, the Lifetime Capital Gains Exemption, under new rules just passed under the budget, which was just passed last week by the recording of this video, means that a business owner can claim $1.25 million of that capital gain tax-free. You can calculate the tax on your marginal rates and see why this is very important. Now, that could be solved by a different company owning that policy or transferring it into an investment company. Another issue that people run into is how a policy is paid. For example, if one corporation is paying the premiums for the policy, but another company is going to receive the benefit of that policy, you could run into a serious situation. And the problem is the construction of a shareholder benefit between related corporations. And this could be within related companies or within a conglomerate of companies. This happens a lot in a lot of complex structures. And so it really should be vetted by a tax lawyer when considering the payments and benefits if coming from a separate company. Now, none of this means that a corporate life insurance strategy is a bad idea. In fact, it could be a very effective solution for estate planning, capital accumulation, buy-sell agreements, tax-efficient wealth transfer, but you need to plan around the cash surrender value issue. But this needs some special consideration on the cash value of the policy, especially when contemplating the sale of a business. And this is where I, as an advisor, always engage in a tax lawyer or the client's CPA to have a conversation around who should pay for the policy, for how long, and in what volume. So the big takeaway is this: corporate life insurance is not taxable on the annual accumulating value of the cash value inside that contract, but the policy cash value is considered a passive asset which requires an additional layer of planning. And if you're not careful, that asset can interfere with your ability to claim one of the most valuable tax exemptions known in the Canadian Income Tax Act, the Lifetime Capital Gains. So if you own a corporation and are contemplating a sale and your company owns a life insurance contract, it's worth having a conversation with your advisory team to make sure that you're not confusing the issue. And if you're contemplating the purchase of a corporately owned life insurance policy, now is the very best time to have your advisors collaborate and talk about which is the right company to own the contract. Because sometimes the biggest tax hits come from places you were least thinking about. And that's why you always need to look out for corporately owned life insurance and the right ownership. If you found this video to be helpful in your journey of history, philosophy, economics, financial literacy, and politics, please hit a like, subscribe, and hit that notification bell for upcoming videos.